All right, hello everybody, and welcome to that episode on my channel. So this week we are going to do a broad analysis of my second largest holding, that is TD Bank. So if you are unfamiliar with my YouTube dividend growth portfolio, I encourage you to check out the prior videos that I made on my channel. I go over my investment thesis on various companies that I have in my dividend growth portfolio. I provide overviews on their business and then do some analytics on their financials as well. So if that is some content that you are interested in, I encourage you to hit that thumbs up button. Please subscribe, it's free. It encourages me to keep motivated to share all of my investing knowledge with you great people here on YouTube. And again, the goal of my channel here is to just spread my investing knowledge to other investors in order to try to help them on their investing journey. So like I said, if that's something you're interested in, please hit that thumbs up button and subscribe. Now, I do not sell a course or anything. I just dive right into the content. So without further ado, let's go and look at my portfolio. So this is my investment tracking spreadsheet. I'm not going to spend too much time here on this in terms of time for the video because I want to spend more time talking about my second largest holding here, TD Bank. It's my second largest holding at about 8.3%, trailing right behind Microsoft and right in front of Brookfield Corp. So let's go and look at TD and their investor presentation for their most recent quarter, which was Q3 2023. All right, so TD Bank Group. They're a top 10 North American bank. They're noted as the 6th largest bank by total assets and the 5th largest bank by market capitalization. So the first couple slides are just talking about their strategy and what they do to drive superior shareholder returns. So their vision is to be a better bank. Their purpose is to enrich the lives of essentially their stakeholders. Their strategy is focusing on the North American financial institutional market, and they have a proven business model. They're looking forward and they're purpose driven. So as we can see here, this is just an extension of their strategy. They say a proven business model, so they have a lot of great customer franchises, a very strong balance sheet, consistent and predictable earnings growth, which is what I like to see in terms of being an investor in the company. Consistent and predictable growth. Forward focused, so again, this is just talking about their investments into growth, purpose driven, and their focus here on their culture and the customer. All right, so let's go and look at their proven business model. So I like the snapshot here. So what they say here is their business model is diverse and scalable, underpinned by a strong risk culture. So there are various business segments. So they have what they call CPCB. So that's the Canadian Personal and Commercial Banking. They have US Retail. So again, this is a Canadian bank with significant operations also in the US. They have the Wealth Management and Insurance segment of their business and Wholesale Banking. So as we can see here, these little dots right here, these represent their retail locations in North America. And there's some green dots here, some black dots here. They're a little harder to see, but those represent TD Securities and TD Wealth. Now, there's about 2,231 retail locations in North America, so a lot of diversity in terms of where they are located. But as you can see, there's large concentrations in specific areas near cities, and then some in some other rural parts as well, and then a couple up here in the north of Canada. Now, here they have those different business segments broken up. So Canadian Personal and Commercial Banking, US Retail, Wealth Management and Insurance. As you can see, very strong deposits here, 442 billion in the CPCB section, 539 billion in loans, which results to about 6.7 billion of earnings. And then we have US Retail here, a large deposit number here, 446 billion. Loans on the smaller side, but still very significant at 245 billion. AUA, which is assets under administration, at 48 billion. AUM, again, an extension of AUA, meaning the same thing, 48 billion. And earnings here, as you can see, very significant in the US, 5.9 billion. Now, Wealth Management and Insurance, smaller end here in terms of deposits, but these are very high margin businesses, Wealth Management and Insurance, and those result to about $2.1 billion of earnings. All right, so I had a couple questions, and if you've seen my prior videos, you probably know, or my past videos, I've kind of alluded to the fact that the banking system here in Canada is much different than the banking system in the United States. And this one slide actually helps me illustrate that point, because a lot of people ask me all the time, why do you have so much of your portfolio in TD or other Canadian banks? Banking, might not provide great shareholder value or total returns. And in all honesty, banking, there's a bunch of banks. What makes a bank unique? So what's really unique here is the geopolitical structure and the way that these banks are allowed to operate in Canada compared to the United States. So I'm gonna go break down this slide and you'll see what I mean. But speaking to that point, the Canadian banking system compared to the US banking system. So the US banking system has over 4,600 banks with market leadership positions held only by a few large banks, meaning 5 of the largest banks have assets 50% of the US GDP. So again, right here, you're thinking Bank of America, JP Morgan, but there's so many other smaller financial institutions and banks here, which increases the competition. Now, when you're talking about the Canadian banking system for a contrast, the market leadership here is held by what they call the Big Five Canadian banks. So those big five being RBC, so that's Royal Bank of Canada, TD, Toronto Dominion. We have CIBC, that's Canadian Imperial Bank of Commerce. We have BNS, that's the Bank of Nova Scotia. And then we have BMO, that's the Bank of Montreal. So those big five Canadian banks account for 73% of the residential mortgage market. So this is huge. These banks, now, they own essentially 73% of the residential mortgage market, thereby controlling a large market share of the banking sector. So that is the huge difference here in Canada. They have much more monopolistic or oligopolistic features here because of the geopolitical environment that they are allowed to conduct business in. So that is what I wanted to illustrate with this slide. Now, going on to the next slide, we can see that TD is a top 10 North American bank. So let's go and look at this in terms of what they call the ranking. So total assets, they have 1.9 or 1.87 billion or really. So then the total assets here, again, I'm just going to look at the rankings. They come in second here in total assets in terms of being a North American bank. Total deposits, like we saw, very strong. They're in the second position. Market capitalization, second position here. Reported net income in the second position. Average number of full-time equivalent staff. Again, not sure if that's really a relevant metric here, but they are first here in Canada. Common Tier 1 equity capital ratio. So if you're unfamiliar with the equity capital ratio or Tier 1 ratio, that is essentially in terms of their assets versus how they're able to operate. So I encourage you to look that up. It's a very simple explanation, but again, they are here in the first in Canada. And their counterparty rating by Moody's, again here, TD Bank Group, it says in Canadian ranking not applicable, but here they have a A1 rating. So very, very great credit rating from Moody's. So that's the Canadian rankings. And if you want to look at the North American rankings, as you can see, 6th, 6th, 5th, 6th, 1st. So again, very, very strong numbers here in terms of specific criteria in ranking when comparing to other banks. All right, so we talked about their diversified reporting or revenue mix when we saw the Canadian and US operations. So we're going to speak to that a little bit more. So here, what we called CPCB, so the Canadian Personal and Commercial Banking, makes up about 44% of their earnings. So that might be surprising to a lot of people because TD being a Canadian bank, a lot of people might thought that they get their lion's share or most of their revenue from Canada. They actually get 44% of it from that Canadian personal and commercial banking. A large part is from the US, being 30% of those earnings. So they are diversifying into the US, like they say, with attractive growth opportunities. So a nice earnings mix here. Now, they also made a small investment into Charles Schwab, 5%, for which they get, that income coming in. Again, it's not huge in terms of their earnings, but that's nice to see as well, diversifying a little bit there. Other wealth management and insurance. So TD has its own branch of wealth management. They have their own discount or their own brokerage. They also have their own insurance products, TD Insurance for home. I have TD Home Insurance. I like it a lot. They have travel insurance, property insurance, casualty insurance, all over the place. So very, very great products here that they offer to their consumers and stakeholders. And then wholesale banking here at 7%, focusing on those client-driven businesses. So a great reported here earnings mix. All right, so what we want to look at next is the consistent earnings growth. So this speaks to the point of a lot of people ask me, why invest in banks? They're not really growing. But when you actually dig down and look at the numbers, they do grow consistently if you pick the right banks to invest into. So these Canadian banks are very strong. So if we look at the 5-year CAGR, and that stands for the 5-year compound annual growth rate. So their earnings from 2017 to 2022 are shown here. Their reported earnings have grown at 2.6% per year over the past 5 years. And their reported earnings per share have grown at an even higher rate at 11.5% per year over the past 5 years. Now, if you adjust for other one-off items, they result to 7.8% and 8.6% adjusted, But still very, very strong earnings growth numbers here from TD Bank. Now, the banks, as you should know, and if you don't, that's totally fine. They are great dividend payers. Now look at this, 166 years of continuous dividend history. They've been paying out these dividends for such a long time. So great dividend payments and reliability of these dividends. Currently, they offer a 4.7% dividend yield. And again, this was back in Q3, so we'll look at what they're offering now, but it's still in this range. So great dividend yield, nice dividend income. So this could be an option when you're looking at something in terms of retirement for providing you great dividend income. Or again, in my case, great dividend income for me to reinvest and get more shares, therefore increasing my dividend snowball effect and allowing me to get more dividends down the line when I need them in retirement. They exceed a target payout range of 40 to 50% of this dividend payout ratio. So again, enough money here to pay out the dividend and also reinvest back into the business. What I love here is, so 1995 here, you can see they're paying out 22 cents per share in dividends. And in 2023, that has grown to about $3.84 per dividend. Per share. So a dividend per share. So from 22 cents dividends per share all the way up to $3.84 dividends per share. So that's over 28 years of dividend growth here and growing at 11% per year over those 28 years. So that is a very strong dividend growth rate, and that is just amazing for me as an investor, because investing back here, you would have locked in amazing yields on cost and been able to reinvest all this dividend income into additional shares, like I said, to keep compounding your wealth and growing those dividends over time. So let's look at the total shareholder returns, and that's why we're investing. So when we look at the total shareholder returns, we're going to be looking at these different time frames. So 1 year, 9.4% per year. So a very great return. 3 years, 18.5% per year for those 3 years. 5 year, 6.8%. And then on the 10-year basis, 11.5% per year over that 10-year period. That is why I love the Canadian banks and TD here in particular. A lot of people think they are very boring businesses with not much growth. If you're giving me 11.5% per year over a 10-year period, I will take that any day of the week. And when we look at the valuation metrics as well later in the video, you will see why. So those are just amazing returns here from a boring old bank. All right, now we're going to look at how they drive that shareholder value. Just a brief slide I thought I'd share here with you. Again, you are welcome to read this. I like to focus here on these medium financial targets. So above peer average total shareholder return. So when they say peer average, comparing to those other North American banks, they're shooting for 7 to 10% adjusted earnings per share growth, or EPS growth. And that is great growth in terms of earnings per share. So I like to see that targeted 7 to 10% earnings per share growth, and I love to see them communicating that to investors. and they're saying they can continue to deliver 16% plus returns on equity. So great returns on equity there by using their operating leverage and keeping that dividend payout ratio between that 40 to 50% targeted range, thereby reinvesting some other money back into the business, not paying it all as a dividend, and then they are able to keep growing and delivering strong, sustainable shareholder returns over a long period of time. So that was the investor presentation. Now what I want to do is go to Qualtrum and do a trend analysis on their results. So I like to look at Qualtrum for a graphical representation, and we're going to be looking at TD's revenue. So TD's revenue has been growing steadily over the past couple of years, and as we can see over a 10-year period, it has grown at 7% per year over the past 10 years. So not huge revenue growth, but again, revenue is not the end all and be all. We need that revenue to translate to profitability. Now, what we want to look at is the earnings before interest, tax, depreciation, and amortization, otherwise known as EBITDA. Now, EBITDA, it does go through its cycles, but as you can see, it is growing at an average rate of almost 9% per year over the past 10 years. So very great growth there in terms of EBITDA. Now, what about net income? All about that bottom line. It is growing at an even faster rate, 10.59% per year over the past 10 years. So great net income growth. Awesome to see here from TD Bank. Earnings per share growth, like we saw, where they're shooting for that 7 to 10% earnings per share growth. And as we can see, they've been doing this for a while. So ever since 2010's kind of been on a staircase up. And we can see over the past 10 years, they've exceeded that 10% earnings per share growth, almost closer to 11% here in terms of earnings per share. Now, what else I want to look at is, because they do pay these dividends, how fast they were growing them. So we did see they were growing them over that 28 year period at about 11% per year. Now here at a 10-year period, you can see that the dividend growth has slowed down. It's still very respectable in my opinion. So it's still growing. It's at about 6.35% per year over the past 10 years. So still respectable dividend growth, and reinvesting those dividends, I believe, will still lead to great market beating returns, in my opinion. All right, now the shares outstanding. So these haven't really moved over the past 10 years. They've kind of been stagnant here and kind of been, at this 1.8 billion shares outstanding. But we had an announcement from them recently, and it was a great announcement in my opinion. So they actually announced that they were going to repurchase for cancellation up to 90 million of their common shares. So we're going to scroll down and read this. So TD announced today, this was August 24th, so just about a month ago or 3 weeks ago, that upon the completion of the repurchase of the shares of cancellation that they had for 30 million of its common shares under its existing normal course issuer bid, it intends to terminate this 30 million bid and instead wants to launch a new normal course issuer bid to repurchase for cancellation up to 90 million of its common shares, representing approximately 4.9, almost 5% of those 1.8 billion common shares issued and outstanding. So TD is going to buy back almost 5% of the share float. That is amazing. So they are going to buy back 5% of those shares and cancel them, thereby increasing your equity ownership in the company by that 5%. So that is a very aggressive common share purchase plan, and a lot of this probably stems from their current I don't want to say failed acquisition, where they tried to buy Horizon Bank in the US. So they had a lot of extra cash. So now that did not go through, they are actually using it to buy back these shares, as they believe that this will provide the most shareholder value for them at this point in time. And I'm totally happy with it. And reducing the share count by 5%, that's just music to my ears. And that is great news for me as a TD shareholder. Now, what we're going to do is look at TD on Go Finance. I've pulled it up here as well. So I'm doing this in terms of valuation. Some people have always asked about valuation on my videos. I'm just going to do a quick and dirty valuation here, just in terms of the banks. But TD here, one valuation metric is the price to earnings ratio. So as you can see, it's trading at a 10.86 PE ratio. So that is very reasonable, in my opinion, for a company that's going to grow, most likely 10% plus earnings per share growth over the foreseeable future, that pays a 4.58% dividend and is returning 5% back to us in the form of a share repurchase and cancellation. So just right there, they're providing, basically 10% on a 10 PE ratio. And when you look at it on a forward basis, it's actually closer to 9. So that's just a great company and a great valuation, in my opinion, to be able to add this company to my portfolio. Now, I've been buying heavily into TD. Like you saw, it was about 8.3, 8.4% of my total dividend growth portfolio here that I showed you on YouTube. So I'm very bullish on Toronto Dominion Bank and the future results of the company. And like I said, I believe they will, again, deliver me decent and great returns, not amazing returns. I'm not expecting 17, 18% per year from Toronto Dominion Bank, but I believe that they can provide me with 11, 12, 13, 14% returns per year for the foreseeable future as they grow and they pay this reliable dividend and buy back these shares. So again, I think that they will do very well for me here. And just in terms of these valuation metrics, I don't believe that they are expensive at all. You're buying a great company for what I believe to be not a fair price. I believe it's an actual great price in my opinion. Now, again, if the market does dip a little bit more, then you could get it at an even better price. So it's an amazing business in my opinion here. So what we're going to do is look at the growth of a 10K investment or $10,000 investment if you had invested it into TD over 20 years ago and compare that to the benchmark here being the S&P 500. So we're going to be looking at the growth of $10,000 if you invested into each of these vehicles, TD or S&P 500, without the dividends reinvested. So as you can see here, it's over a 20-year period. Now the average annual return for the S&P 500 here in this blue line, that $10,000 would have grown to about almost $51,000, resulting in about an 8.47% annual average shareholder return over that 20-year period. Now, if you look at TD Bank here in the black line, that $10,000 would have grown to $65,000, which would have been a higher return at about 9.85% per year over the past 20 years in terms of an annual return. So that is super great to see. Again, TD here outperforming the S&P 500 without dividends reinvested. Now, with dividends reinvested, you can see that the outperformance gets even greater. So right here, that $10,000, if you were comparing it to the S&P 500 and TD, S&P 500, that $10,000 would have grown to $62,000, almost $63,000. Now with TD, it would have grown to basically $92,000. And again, the average annual total returns here, S&P 500 at 9.63% per year and TD at 11.74% per year. So this is a market-beating return here by TD when you're comparing it to the S&P 500 for each of those 20-year time periods without and with dividends reinvested. And with the dividends reinvested here, as you can see, it's basically a 2% or 2.1% per year outperformance from TD compared to the S&P 500. So again, those dividends here do really make a large difference. Reinvesting those dividends just compounds that dividend snowball and allows you to get a larger average annual total shareholder return. So just thought I'd share that for you. Again, a lot of people, they were commenting on my portfolio and asking about Canadian banks and what I thought about them and why I loved investing into them. I believe that this right here should illustrate a strong point as to why I do love investing into these vehicles. Now, this is TD Bank, but what about some other Canadian banks? So what I've done here is I've opened up a popular ETF that a lot of Canadians invest into. It's called ZEB. It is administered by the BMO or Bank of Montreal, and it's the Equal Weight Banks Index ETF. So basically, this is exposure to the Canadian bank stocks, and it's managed by BMO Global Asset Management. So just like any ETF, it has an expense ratio, so that's 0.28. It has an annual management fee of 0.25. Now this fund was started in 2009, and it has a benchmark, the Selective Equal Weight Canadian Banks Index. And you're welcome to pause it and read this. I really just want to go and focus down to the core of the, I'm looking at the fund fact sheet here. So the fund performance, and again, this is over a 10-year period. So this would have been since 2013, July 31st, 2013, up until July 31st, 2023. It's returned 10.34% per year over the past 10 years. So very, very strong growth in these Canadian banks in terms of annualized performance. Scroll down, we can see the top holdings. So like it said, it's an equal weight banks index ETF, and it's holding all of the large banks that I talked about, besides the 6th tier, a new player, National Bank. So they basically have roughly 17 to 16% each of a weighting here in this portfolio, and the largest being Royal Bank, followed up by TD. Then we have Bank of Montreal, Bank of Nova Scotia, CIBC, and National Bank here as well. I also added National Bank into my portfolio this past week, but I'll save that for a different video or that discussion. But it's basically the same thesis as why I hold on to Toronto Dominion Bank as well. So again, I just thought I'd share an ETF here that is possible, that is popular in Canada, again, because of the strong performance of these banks and their monopolistic and oligopolistic features. So to conclude, we are going to go back here to my spreadsheet, and you'll see why. Like I said, I have TD at an 8.3% weighting in my stock allocation, and as you can see here, Canadian banks make up about 9.3% of my total YouTube dividend growth portfolio. Again, I like these Canadian banks because they are monopolistic. They operate in a geopolitical environment which fosters almost this monopolistic or oligopolistic business nature. It's built well for it. Policies are designed for it. Even when you're looking at the telecom space in Canada, there are there's only a handful of players here. So in Canada, it seems to like its monopolies. I don't know why. It is just that way in the business environment here in Canada. So for that reason, I really like TD. It's not going anywhere in my opinion. 166 years of paying a dividend, strong dividend growth, 11% per year dividend growth over the past 28 years. It's had a total shareholder annual return of 11.45% per year over the past 20 years. Great revenue mix, I believe, with the US portion, the Canadian portion, wealth management, the investment in Charles Schwab, and I believe that they're poised for aggressive growth in the future. As soon as they're able to continue expanding into the US or add on to their current product offerings. So that was TD, their business overview in a nutshell, and sort of touched on the strength of the banking sector and why I believe in investing into the Canadian banks for long-term total shareholder returns. Again, something I kind of like to say here is these banks are paying for great companies at great prices or fair prices, and they are reasonable, predictable growth. So you're paying for reasonable, predictable growth at fair prices. And that is what I love to hear. Music to my ears as a dividend investor. So that was TD again. Hope you enjoyed the video. If you did, please leave a like and subscribe. And if you have any comments, please leave them in the comments section below. I'd love to get a discussion started. And without that, I will see you in the next one. Thank you for listening, and I hope you have a great day. Bye. Please note, I am not a financial advisor by any means. This video is merely for your entertainment purposes only. I am not liable for any investing decisions you make. Investing is always risky, so please do your own due diligence when investing, as again, I am not liable for any investing decisions you make. Thank you again, and have a great day.